Hello everyone and welcome back to Fun with Fitzy. Today's video we're going to be talking about what we learned a little bit in grade 11, depreciation. So this is our chapter on capital assets, and of course with our capital assets we need to depreciate them, and in this course we're going to use the terms depreciation and amortization interchangeably. There are some differences, but for the purposes of this level of accounting, if you hear the word depreciation, we're going to also assume amortization is the same thing. What is amortization or depreciation? It is the process of allocating to expense the cost of a capital asset over its useful life in a rational and systematic manner. Okay, so I don't really love that definition, so what I'd like to say is amortization is the process of spreading the cost of the asset out over time. And this cost allocation, or the spreading out of the cost, is designed to provide for the proper matching of expenses with revenues in according with the matching principle. So here we have another gap that we're bringing back into this course, and the gap is the matching principle, which states that you have to match your expenses in the same period in which they help you earn revenue. So if you think of a pizza delivery car, if you purchase that car at the beginning of the useful life and the car helped the company deliver pizza for 10 years, well, it helped earn revenue for 10 years. So part of that cost needs to be matched up with the revenue for those 10 years. So that's really in essence what we're doing. We're taking capital assets and we're converting them to expenses over time. Just like we did in chapter 3 when we were adjusting for supplies. Supplies were an asset, and then eventually they were flipped to the supply expense account, because actually assets are expenses if you think about it. So that's what we're doing. We're turning our fixed assets, we're spreading the cost out over time, and we're charging an expense account. So during an asset's life, its usefulness may decline because of wear and tear or obsolescence. So it gets older, it becomes obsolete. So there are different methods of amortization that we're going to talk about because of that. Recognition of amortization does not result in the accumulation of cash for the replacement of the asset. There is no cash involved in doing this adjustment. So in chapter 3, we did talk about the adjustment for depreciation, and we are going to still use that exact same adjustment. And if you recall, we never use the account cash when we're doing any adjustments. And keep in mind that land is one of the capital assets that we do not amortize because it actually is known to appreciate, not depreciate. It means it goes up in value over time. So what factors do we need to take into account when we're doing our depreciation or our amortization? We need to talk about the cost. So what was the cost of our asset? And we learned last time the cost includes all of the things that help us get it ready for its intended use. We need to know how long we estimate the asset to be useful for. So that's a useful life. It's an estimate of the expected life based on the need for repair, service, and whether or not it's becoming obsolete or not. And of course, salvage value. This is also known as residual value, and this is an estimate of what we think the asset's value is at the end of its useful life. So if you think your pizza delivery car is going to be useful for 10 years, which is probably not reasonable this day and age, but in 10 years, let's just go with it, how much do you think we could sell that car for? Do you think we can get $2,000 for it? And if so, that would be our estimated salvage value. Now, there are several methods of recognizing amortization. One is called the straight line method, which you have learned in grade 11, hopefully. We're going to talk about the units of activity, which is similar to the straight line method, and of course the declining balance method, which of course you should have learned in grade 11 as well. Each method is acceptable under our GAAPs or IFRS principles, And managers get to select the method that they think is appropriate for their company. Once a method is chosen, it should be used consistently year after year. Okay, so that was a short video. By now, you should be able to describe what amortization is and be able to name 3 types of amortization. Our next videos in this series is going to be describing how to use each amortization method. Thanks for watching.